Welcome back to The Explainer. Let's step straight into the war room today. I'm putting on my seasoned financial advisor hat because, look, this week is shaping up to be one of the absolute most pivotal stretches for U.S. stocks in the entire second quarter of 2026. If you've been riding these incredible market highs lately, it's time to sit down, focus, and seriously review our defensive strategies. Over the coming days, we are going to see a massive convergence of macroeconomic data, a truly historic central bank transition, and some explosive tech earnings. Let's get right to work.
Okay, let's dive into this war room briefing. We're covering the gathering macroeconomic storm, navigating the Fed transition, the tech vanguard and AI bellwethers, and finally, your tactical playbook.
Section 1, the gathering macroeconomic storm and preparing for the April CPI impact.
Before we can even think about looking at individual stocks, we really have to understand the broader economic weather patterns out there. And here it is, the single most important number of the entire week, 3.7%. That is the expected April Consumer Price Index, or CPI, year-over-year figure. Think of this print as the ultimate weather report for your portfolio sailing right now. A cooler print? Well, that means smooth sailing. But a hot print hitting that 3.7% means we absolutely need to batten down the hatches. Inflation is expected to rise for a second consecutive month here, jumping up from 3.3% in March. That would officially mark the highest reading we've seen since September of 2023.
So you're probably asking, why exactly is inflation accelerating again? It really comes down to geopolitical energy shocks. The U.S. national average gasoline price has climbed nearly 50% since the war with Iran started, pushing right past that $4 per gallon mark. But the real danger here isn't just the pain at the pump. The real threat is that these surging energy costs bleed over into the core CPI, which, remember, normally strips out volatile food and energy. If core CPI breaks above its expected 0.3% month-over-month, it means this inflation is becoming deeply entrenched across non-energy sectors.
And that brings us directly to our best case versus worst case scenarios. In the best case, that CPI data cools off. The energy cost spike stays totally isolated. And crucially, rate cuts stay on the table for the Fed. But the worst case? A hot CPI reading forces the Fed to delay those rate cuts entirely. Keep in mind, the S&P 500 just closed at a record 7,398. It has been on a 6-week winning streak, the longest we've seen since 2024. A euphoric, record-breaking streak like that leaves massive room for a sharp, sudden correction if the inflation narrative suddenly turns sour on us. Moving on to Section 2, navigating the Fed transition, a changing of the guard. This rising inflation data is crashing headfirst into a truly historic leadership change at the Federal Reserve. Just think about the gravity of this timeline. Jerome Powell's term as Fed chair officially ends this Friday, May 15th. The entire market is basically holding its breath right now, bracing for the U.S. Senate to confirm Kevin Warsh as his successor this week. We are literally getting the most critical inflation data of the year at the exact moment the institution responsible for fighting it is switching captains. Now, what's really interesting about this is the fascinating divide opening up within the Fed itself. On one side, you have the incoming chair, Kevin Warsh. The market generally views him as a pragmatist. He focuses heavily on long-term market expectations, and he's seen as being more open to rate cuts. But look at the other side of the aisle. At the latest Federal Open Market Committee meeting, 3 voters were ready to dissent over policy language. These more hawkish voices are actively pushing back, demanding significantly softer inflation data before they'll even consider agreeing to cut rates. This internal tug-of-war is going to absolutely dictate the market's trajectory for the rest of the year. Section 3, the tech vanguard and AI bellwethers, hardware, earnings, and geopolitics. Okay, zooming in from the macro weather to specific sectors, check out this phenomenal development from Micron. They've officially achieved high-volume production of their HBM4 memory, which is specifically designed for NVIDIA's next-generation Vera Rubin platform. This is not just some minor iterative upgrade. This hardware pushes bandwidth greater than 2.8 terabytes per second. This is a completely tangible bellwether for the whole tech sector. High-bandwidth memory is literally the fuel for the AI revolution, and Micron's ability to mass-produce this at scale is a massive, massive signal of underlying demand. And this is exactly why these specific hardware innovations matter so much for us. Micron's HBM4 doesn't just offer raw speed, it actually achieves 20% better power efficiency. They're also mass-producing the industry's very first PCIe Gen 6 data center SSD, the Micron 9650, which is totally optimized for liquid-cooled environments. So why is this crucial for your portfolio? Because even if the wider semiconductor market faces a cyclical downturn, the sheer unyielding demand for highly energy-efficient, massive capacity AI infrastructure, stuff like their 1992 GB SoC M2, might completely offset those broader market weaknesses for these specific companies.
To put into perspective just how incredibly hungry Wall Street is for this specific infrastructure, you have to look at the Round Hill Memory ETF, ticker symbol DRAM. It launched just 36 days ago, and it has already shattered every single ETF launch record in history, pulling in an astonishing $6.5 billion. On one single Friday, the fund surged 13% and pulled in $1 billion in fresh inflows. This is the sheer scale of the AI boom, visualized. But keep in mind, when $1 billion flows into a fund in one day, that is pure momentum chasing, which definitely introduces some extreme volatility risk.
And that volatility leads us straight into this week's critical earnings checkpoints. We've got 3 massive reports to track. For Cisco, we're watching closely to see if their massive $2.1 billion AI networking order pace holds up alongside their $5 billion full-year guide. For Alibaba, expectations are pretty cautious right now. 13 of 14 analyst revisions point downward, and options are pricing a near 6% swing. But the absolutely critical one is Applied Materials on Thursday. Options are pricing a massive 8.7% move. AMAT is a major leading indicator because they sell fabrication equipment to virtually every chip foundry on Earth. If they show weakness, that 8.7% volatility will signal severe correction risks for the entire tech sector. And right in the middle of all these earnings, we've got a massive geopolitical wild card dropping. The Trump-Xi summit takes place on May 14th and 15th. The leaders of the world's 2 largest economies are meeting specifically to negotiate AI guardrails. Look, objectively speaking, no matter what their politics are, the reality for investors is that the outcome of this diplomatic summit will directly impact global semiconductor supply chains and overall market stability.
Finally, Section 4, the Tactical Playbook, your weekly battle plan.
So, how do we actually survive this crucible? First, we have to look at how different market participants react to this kind of intense volatility. Institutional portfolio managers, the pros, they use hedging tactics. They're going to wait patiently for the Tuesday CPI data to settle before they commit to adjusting their asset allocations. Retail investors, on the other hand, unfortunately often fall into emotional traps. They tend to react to short-term earnings volatility on a single stock, or they get caught up in FOMO, the fear of missing out, when they see an ETF spike 13% in a single day. You need to think and act like the institutions this week. And this brilliantly illustrates exactly why. To think like an institution, you have to map out the chronological gauntlet the market has to run this week. Tuesday morning, 8:30 a.m. Eastern, the CPI drops. That is the main event. Wednesday validates those numbers with producer prices right alongside Cisco and Alibaba earnings. Then Thursday is just a massive bottleneck. You've got retail sales, the highly volatile Applied Materials earnings, and the Trump-Xi summit hitting all at once. Finally, on Friday, consumer sentiment data lands right as Chairman Powell's term officially concludes. Seriously, you might want to keep this calendar taped to your desk. To safely navigate that gauntlet, I've put together a strict defensive checklist specifically for retail investors. Number 1, objectively evaluate your high-growth tech stock exposure right now, before the data hits. Number 2, do not over-leverage yourself before Tuesday's CPI print. Number 3, always check options implied volatility so you aren't completely blindsided by something like an 8% swing. Number 4, look beneath the headline numbers. For instance, watch if Cisco's shift to cloud subscriptions with Splunk ends up dragging on their short-term revenue. And finally, track if that 50% spike in gas prices we talked about is starting to bleed into other CPI sectors. Based on that checklist, here is a very clear step-by-step plan for timing your market entries this week. Step 1, hold your capital. Do not commit fresh capital in any significant size early in the week. Step 2, evaluate Tuesday. Watch exactly how the market and the incoming Fed leadership digest that critical inflation print. Step 3, deploy selectively. Wait for Applied Materials on Thursday to confirm the actual health of the semiconductor space before you start buying into the tech rally. Remember the golden rule of the war room. A delayed profit is far, far better than taking a loss because you misread the macroeconomic data. Well, we've covered the inflation threats, the changing of the guard at the Fed, the booming AI hardware sector, and exactly how you can protect your portfolio. Which really leaves us with the ultimate question for the days ahead.
Will the S&P 500's record-breaking run actually survive this massive convergence of Kevin Warsh's pragmatic Fed transition, a potentially blistering 3.7% CPI print, and an explosive week of AI earnings? The data starts rolling in on Tuesday. Stick to your battle plan, manage your risk closely, and I will see you on the other side of the